Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. As we celebrate the birth of the United States this month, we're going to talk about a method of investing that doesn't take all that much work, but can produce awesome returns. Today, we'll talk about passive investing without the active headaches. And we've got a great guest on the Real Estate Guys radio program. As real estate investors, it's no secret that the real estate guys love Florida, and the Sunshine State continues to receive more than its fair share of businesses and population relocating from the Northeast, which has created a huge opportunity for real estate investors. So come join Russ and me in mid-August for our Jacksonville, Palm Coast, Ocala field trip. On this highly interactive trip, you'll get an up-close, hands-on, personal experience you'd be hard-pressed to find elsewhere. You'll feel the vibrancy of the markets, observe the quality of the infrastructure, and truly get a sense for the demographics, all things you just can't do by simply searching online. Plus, we'll introduce you to our Boots on the Ground team, and you'll meet some amazing investors from all over. To reserve your spot, go to realestateguysradio.com and click Events, where you'll find the Jacksonville field trip. There's a big difference between researching a market from afar and seeing it with your own eyes. So join the Real Estate Guys as we explore not one, but three amazing real estate markets. Go to realestateguysradio.com and click Events for the Jacksonville, Palm Coast, Ocala field trip. See you there. Welcome to the Real Estate Guys radio program. I'm your host, Robert Helms. Joining me, as usual, it's our co-host, financial strategist, Russell Gray.
Hey, Robert.
Lots of folks that listen to the Real Estate Guys are active investors. They're rolling up their sleeves, they're finding properties, they're kicking dirt, they're putting together all their team members, and they're finding the properties. Some even go so far as to do work on the properties. Maybe they're in development or property management, or they just get out a paintbrush. But there's a whole nother crop of real estate investors who don't do any of that. They don't like tenants, toilets, and termites, and they invest passively. And today we're going to focus on the opportunities for passive real estate investors.
Well, I think one of the big changes going on right now is we're sitting here staring at a stock market that is off to the absolute worst half of history. I mean, in the last, it's 50, 60 years, the bond market, the worst bond market start for the first half of a year since 1865. So we joke all the time about how the world we live in is considered alternative assets, which is hysterical because the types of things we invest in were around a lot longer than these paper assets, these stocks and derivatives and bonds and mutual funds and 401k. All of that stuff came into existence long after real estate, oil, gas, food, commodities. So it just cracks me up. But I think right now you've got, of course, everybody out there who has always believed in real estate and watched Flip This House and decided to go out and buy a home, and they had equity happen to them in their personal life and say, hey, if that worked once, why not do that 2, 3, 4, 5, 10 more times? But to your point, when you get into that world, it seems all like it's a passive investment, but owning a rental property is not necessarily a passive investment. And clearly, if you want to go bigger, you've got both the limitations that come with the size, the amount of credit, the amount of capital that you need, the intensity of the management, the skill set involved. And so you kind of default and say, hey, now I got bigger money to invest. I'm going to go turn it over to a fiduciary and give it to Wall Street. And I think some people out there are beginning to rethink that right now and going, hey, you know what? I kind of like the yields in real estate. I like the equity growth, the inflation hedge in real estate, the tax breaks in real estate, but I don't want to get my hands dirty, and I certainly don't want to play small. I want to be part of the bigger, more profitable deals with professional management. How do I do that? Maybe a real estate investment trust or this thing we call private placements.
Nothing wrong with owning individual investment properties. Actually, nothing wrong with managing them yourself, at least to start. But if you have any idea of getting to larger properties, more income, bigger scale, you have to consider real estate syndication. And it doesn't mean you have to be the syndicator. We have lots of folks in the world that want to do that, and they come out to our 2-day syndication event, and we get to meet them, and it's awesome. But there's also the other side, which is I have a busy life or business. I got a lot going on. My kids are in school. I want to travel the world. I don't really have time to go to market after market, kick a bunch of tires, try to figure out what agents are ethical. I would just rather find somebody who is investing in solid real estate with potential return and come alongside that person. And that's what a private placement memorandum is. It's just a fancy term for the legal documentation required when people pool their resources. What syndication is a bunch of folks putting together various skills and resources. Some people find the property, some people do the management, some people get the financing figured out, some folks supply the capital, and there's a lot of overlap in that. And I think today we'll focus on actually the legal side of what it takes to become a passive investor, because we have a great guest who's an attorney with us today.
Yeah, and I think one of the other things to realize is that the types of deals we're talking about, you see every day. When you're driving down the street and you see somebody putting up a little strip mall or an apartment building or medical office building, I drive in Arizona, I drive up and down Ray Road, and I see all the time this little development project that we funded way back in 2005, I think it was, and now it's a vibrant complex. It's very full. I remember the little sapling trees that got planted way back when, and now they're big, full trees. And you realize that that was a project that the community needed. It's serving a vital need in the community, and it took capital to get it built. And so we brought capital and coordinated the development. A construction company came in and did the build, and that thing is still existing today. And so there are people listening to the show right now that have their money in Wall Street that are rethinking the wisdom of that and realize, hey, there's this whole other world, but I'm an outsider. I don't even know how to get into the game. I have no idea who to talk to, how it works. I think we're going to unpack some of that mystery today and tell you not only how it works from a legal perspective, but I think we'll also, I hope, have time to cover a little bit about how do you actually find these deals? How do you meet these people? And how do you actually get in the game?
Our guest today has been on the program several times. He's a securities attorney. We've known him for decades. And Mauricio Rauld is going to share with us today what you need to think about if you're considering passively investing in real estate. You'll meet him when we return. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Need help with your real estate investment portfolio? Check out the resources page at realestateguysradio.com.
If you love real estate and have always wanted to own your own business, listen up. The Real Estate Guys and their panel of experts want to teach you how to go full-time fast in the real estate syndication business. These next few years may go down in history as one of the best times ever to acquire investment real estate. There are deals everywhere if you know where to look and how to assemble the resources. The Secrets of Successful Syndication seminar will show you how to make big money doing big deals from a team of experts that have syndicated projects totaling more than $1 billion. Don't wait for someone to give you a raise or create a job for you. Attend the Secrets of Successful Syndication and learn how to build a team, raise capital, find deals, and make full-time money in 6 months or less. Go to realestateguysradio.com and click on events. All the big players use syndication as a way to diversify risk, optimize profits, and earn big money. You can too. Go to realestateguysradio.com and click on events.
When it comes to successful rental property investing, it pays to be picky. Pick the right markets, pick profitable properties, and pick great property management. That's easier said than done, but we've got great news. Terry Kerr and his rockstar team at Mid-South Homebuyers are going strong in Memphis, Tennessee, and Little Rock, Arkansas, too. So for a top-notch turnkey single-family home rental property, whether you're a new investor or have a large portfolio already, pick Terry Kerr and Mid-South for a truly A-plus investing experience. To learn more, send an email to midsouth@realestateguysradio.com. That's midsouth@realestateguysradio.com.
Having trouble finding deals where the numbers make sense? Invest in an asset class that delivers cash flow to you in good times and bad, and where most of that cash flow is tax-free. I'm Dave Zook. Many of you have heard me speak at Real Estate Guys events or heard me on their podcast. My team is a top 5 ATM operator in the country, and right now accredited investors can make cash flow returns well into the double digits and get huge tax deductions. For your free report on this lucrative asset class, email atm@realestateguysradio.com.
Hi, this is Mark Skousen, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Now in our 26th year of broadcast, we're glad you're here. We're talking about investing in a real estate syndication or other group investment as a passive investor. So as we were talking about kind of two ways to invest, active, where you do all the work, passive, where somebody else does. And to talk about this, our guest specializes in putting together the legal paperwork necessary for these group investments. Welcome back to the Real Estate Guys radio program, attorney Mauricio Rauld.
Hey, Robert, how you doing?
I'm good. How are you?
I'm doing excellent. Thanks for having me back.
It's always good to have you on the program. You've been on a lot. And normally when you're on the show, we're talking about how folks that want to syndicate a deal, put together all the pieces, do a bigger real estate deal where they're raising money, can do that. But today shows the other side of that. So you have a lot of clients that are real estate syndicators, and they do everything from, a group of single family houses to development to big commercial to multifamily, even some things that aren't real estate. And it's the same premise. Now, today, the emphasis is going to be, what about the person that says, I'd love to have exposure to that. I want to be part of a multifamily investment, but I don't have the wherewithal, I don't have the experience. So let's start with the passive investor and some of the big things they need to know before they invest in a syndication.
Yeah, I get that question a lot. Passive investing is obviously an amazing way to get into the real estate world without having to do all the work and basically rely and leverage the experience of a good sponsor, and you get all the benefits that you would if you were buying the whole thing. So, but to me, it always comes down to, and probably the most important thing a passive investor should be thinking about is, the due diligence on the sponsor. Can the sponsor actually pull off the business plan, right? It's one thing to put a pretty pitch deck together, a business plan with all the pretty pictures and all the projections and all that stuff, but can the sponsor actually execute on that plan? That's easier said than done. Anybody can put together a pretty picture and a pretty pitch deck. Not everybody can actually execute on that. So that's probably the number one thing that a passive investor needs to do, is do that due diligence, find out, what is the level of experience of that sponsor. And not only in general, like, are they, have been doing real estate for 25 years, that's great, but do they have experience in the particular asset class? They can be, somebody who's been doing multifamily for the past 20 years, so they're a pro at that, but this might be a mobile home park investment. It might be a self-storage investment. It might be single family homes, which is completely different. So do they have experience in that asset class, or is there somebody on their team? Because they don't actually have to have that. We're all entrepreneurs, so you can definitely bring somebody into the sponsor team that has that expertise, but somebody on the team has to be really dialed in and have that experience on the particular asset class.
So, the analogy we use is the horse on the track and the jockey. So the track is the market that the deal is in, and we'll talk about what a passive investor needs to know about a market. The horse is the deal. That's the project or the property. But the jockey, the person riding the horse, is obviously critical here. So when it comes to passive investing, I think this is an area that seems obvious, but many times the passive investor's busy. The reason they're considering investing this way is so they don't have to do the work, and they almost abdicate responsibility by handing their money to someone. And what you're saying is you better make sure it's the right person.
Right. And I think to your point, Robert, and you teach this all the time, is like a lot of passive investors just want to look at the deal right away. Like, does the deal work? Where, wow, look at the amazing building, and wow, look at the returns, and look at this and look at that. And they don't step back and think about, as you teach us, the deal itself is probably the least important. That's the one that you could substitute the most. What's way more above that list is, again, the sponsor, and can they pull it off? Do they have a team? That's another big thing, right? Like, what if something happens to them? What if they get hit by a bus?
Right.
Like, that's a good question to ask. Like, what happens if you die, Mr. or Mrs. Sponsor?
Right. Who else is on your team, and who has the chops to step in? And this is a very real issue. A lot of times folks that are investing in their own account decide, hey, I'm doing this deal. It's a little bigger I can do on my own. I'll bring in 3 or 4 folks who are each going to give me $100,000, but it's still just me running a property like I would. And that's where the sponsor also needs to think through how they show up when the passive investor is asking these questions.
100%. And so, because, if it's a one man or one woman show, maybe the spouse ends up being the running the show, and they don't have any experience. So you always want to ask, this is just a great question to ask. Like, what happens if something happens to you? What's the succession plan? So I
think, Mauricio, let's talk about this, because in the real world, sounds great. But now from a practical point of view, I've been shown a deal by a sponsor. And by the way, the sponsor is the person who's putting it all together. Sometimes we call that person the promoter or the syndicator or the GP, the general partner, sometimes deal sponsor, right? There's a lot of terminology, but it's basically who's running the ship. And it can be awkward to have to ask some of these due diligence questions, but this is the time to do it. It sounds like a really great deal. Let me know a little more about you and your team. Obviously, in the executive plan or the business plan, the sponsor should detail some of this. So you'll get to see, okay, well, there's this person, and this is our market guy, and here's our lawyer. What about vetting the team? What are the things people really need to pay attention to?
When it comes to vetting the team, that usually happens on the front end too, Robert, right? So generally you have some kind of a pre-existing substantive relationship, right, with the sponsor. And the whole point of that exchange of information is for you to get to know the sponsor. Part of it is for you to get to know the sponsor, part is for the sponsor to get to know you.
Yep.
But that's one of the opportunities that you have to ask all these questions to the sponsor and make sure that you guys are aligned. Because number one, what asset class and why they believe in the asset class, and does that match what you want? What market are they in and why they like that market? Those are great questions. But then even, do their values match up? Like, what are they trying to accomplish? Are they going for equity? Are they going for cash flow? Are they going for appreciation? Are they going for tax benefits? Like, what are they focused on? And does that line up with what you're looking for? Because again, being aligned with the sponsor is probably just as important or the next level down after you've been comfortable with the sponsor itself. But that's some of the stuff you want to be asking about.
Well, and you're going to have, like any real estate transaction, their primary strategy. So let's say we're investing in an apartment building together, and the strategy is to hold it for 5 to 7 years and then sell when the price is up. Well, you may not want to sell. You may, no, I just want the production of income. So now you're looking for a different type of deal. And so this is really critical. Now, at the end of the day, the sponsor does generally decide. So let's say that the plan was 5 to 7 years and you're good with that. And all of a sudden something happens in the market and either there's an opportunity to sell in a year and a half and the sponsor says, we got to take advantage of this. Well, now you got to think about, okay, well, what am I going to do with the money? And I'm making a good return, or they wouldn't have made this decision. Or the opposite happens. 5 years in, the market's terrible, and we have to ride this out. So one of the things you understand as a passive investor is it really is the major decisions are not up to you.
And that's why it's critical for you to do this work up front. I mean, you are a passive investor, meaning at some point when you've made that decision to invest and you write that check and you wire it over or mail it over, you're done. Like, you're not going to be involved in the day-to-day decisions. I mean, you should be updated regularly, and if you've got questions, they should be answered. But the sponsor team's not coming to you to ask for your opinion if whether they should refinance or sell or change management companies. That's going to be totally up to the sponsor at their sole discretion. So that's why the only job you have is all the work that we're discussing now on the front end, which is vetting the team and doing all that stuff on the front end. That's the work you have to do. And the nice thing about it, though, is you do get economies of scale, because once you've done the work once and vetting the sponsor team, then obviously if they have another deal, you don't have to go through that vetting the sponsor team again. You've already done that work. Now you just have to focus more on whether the investment itself matches your own personal investment philosophy.
So I'm glad you brought this up, because it is work. And a lot of times passive investors think, oh, there's no work involved, I just write a check. No, you've got to do this work up front. The good news is once you do, now you are passive. You're generally not going to have anything to do with the management of the property or qualifying for loans or any of that stuff. You're kind of off that hook. But that also depends on the deal.
It does. And the other thing that I was actually just literally posting about this a couple of days ago, that I was surprised that not many people knew about this, but the asset protection piece, the limited liability piece for a passive investor, which is huge, right? You're usually limited in terms of how much you can lose the amount of the investment. If I write a $50,000 check, that's generally the most I could ever lose. But the minute you start inserting yourself into the management decisions and demanding that you should be consulted, and now you're making some decisions, well, now that asset protection piece wanes away. So as a passive investor, you don't want to be involved because you want that limited liability. That's why you're generally called a limited partner.
Excellent point. Now, you brought up this idea of, as a passive investor, I should be getting communication. So let's talk about that. I think that's also an important question. Maybe not a due diligence question, but something to ask the sponsor. Hey, once we do this, how often am I going to hear from you? And I think that's partly dependent on the product type. If you're part of a syndication that's buying a 200-unit multifamily that's already up and operating, well, then you would expect to see some sort of report monthly or at least quarterly where you saw what's happening. If our plan was to go buy a big chunk of land and land bank it for 20 years, well, I probably don't need a monthly update, right? So how do you want to see the information shared from the sponsor to the passive investor?
Yeah, and I think that is part of your due diligence, because that's one of the questions you should be asking them. Is like, how often are you going to communicate? How are you going to communicate? Are you just going to send me an email? Are we going to talk one-on-one? Are you going to do a webinar? There's so many ways. From my standpoint, from a legal standpoint, it doesn't really matter how that information is communicated. It just needs to be communicated and disclose how it's going to be communicated. But like you mentioned, most of our deals do involve a little bit more active management. So it's typical to have an update at least once a quarter and maybe even once a month. And typically it's matched with when the distributions are made. So usually people distribute cash on a quarterly basis. So it typically would have some kind of a report along with that, hopefully with a nice check along with it.
So we talked about the importance of making sure that the jockey, the sponsor, you're clear about them, you understand their history and their experience and their relationships. But what about the other two? What does a passive investor need to do in terms of diligence on the product, the property, and the market?
Well, that's a challenge, right? Because as a passive investor, you're busy, right? You're a busy professional. That's the whole reason you've decided to be a passive investor. So is it realistic for you to hop on a plane and go do due diligence on a particular property? Probably not. But I think the best maybe quote, for lack of a better word, is the trust but verify, right? So yes, everything should be disclosed and is actually legally required to be disclosed, especially if you've got some non-accrediteds in the deal. And we'll talk about that in a second. But there's a requirement to disclose all the material facts, and they should be accurate. But again, your job as a passive investor is to trust but verify. So again, you're probably not going to hop on a plane, but do a little Googling around and maybe even if, there's nothing wrong with you asking for the contact information of the property manager. Maybe you call a couple of property managers and find out, hey, what are the current rents in the marketplace? Or, or maybe you talk to a real estate agent, say, what are the current cap rates? And so there's some things that you can do. But I also understand that, again, as a passive investor, you're a busy professional, which is another reason why it's nice to once you find a good sponsor team and you're comfortable with them, that's one of the reasons people stay with them, because they don't have to do as much due diligence the next time around, and they can leverage that time that they spent, all those hours of due diligence they spent at the beginning.
I think the whole, trust but verify makes a ton of sense. You just want to check the assumptions. So the business plan says, hey, we're in this market because there's this much growth and these many new jobs are coming in and these 3 big employers are coming in. All that is public information, easy to verify. And to your point, if you want to go to the extent of looking at the competitive set, the assumption is we're going to buy this apartment building because the rents are low and we're going to raise them $200 each. Well, a little poking around can show you that maybe the market can't handle $200 right now. Maybe that's over a 4 or 5 year period we could raise the rent that much. That's going to affect it. So are the assumptions realistic when they're telling stories about the market? And usually the sponsor is going to put together a nice package, whether that's a deck or a PDF or whatever it is, and you can just double check some of that. What I've seen happen is a sponsor will have data on the market that's 6 months old, because they started back then, they put it all together, it's nice and pretty, but by the time they get there, the information's changed, sometimes for the better, sometimes for the worse. So remember, it's up to you as the passive investor to get all of your questions answered on the front end, because once you send the money, you're in the deal.
Yeah, and these days, like I said, it's way easier than it was 20, 30 years ago when it was almost impossible to get that information without picking up the phone or hopping on a plane. These days, it's all at our fingertips, so take advantage of that technology.
So assume you found a great sponsor or a couple of sponsors and you like their work and you feel good about the fact that their values and your values match up and all that. Let's talk about some of the basics from the passive side. So you mentioned accreditation. There are some investments that are limited to accredited investors, and there's other investments that are open to non-accredited investors. And then you also mentioned the relationship part. So just kind of cover the basics there. No passive investor left behind.
Yeah, so let's even step back further, I guess, and let's discuss what is a accredited investor and who isn't an accredited. So as it stands right now, and the reason I say that is there's a lot of changes coming around, but as it stands right now, an accredited investor is someone who earns $200,000 a year for the past 2 years with a reasonable expectation of earning that or more this year. Or on the net worth side, they have $1 million in net worth excluding their primary residence. And this is because back in the day, everybody in California was an accredited investor due to their equity in their home. But that's currently the definition of an accredited investor. And there's been a lot of debate and criticisms of that definition, which was came out in 1982, so it's a little bit old, because as we all know, Robert, there's tons of people who are way smarter than we are that just don't happen to be accredited, and that would be fine investing in some of these deals. And then there's people who have a ton of money that are just the dumbest people in the world.
Well, this is the assumption. The reason that there is accreditation as a requirement is the basic premise is, hey, if you've accumulated this kind of money or you earn this kind of money, then you're smart enough to make your own decisions. If you aren't that wealthy, well, then you're going to need help making those decisions or limited from it. In fact, in Robert Kiyosaki's book, Rich Dad's Guide to Investing, it starts with a story about Robert wanting to invest with his friend Mike and his dad, and Mike saying, well, this isn't available to you. And he got upset about it. What do you mean I can't invest in it? And he doesn't use the terminology, but this is exactly what he's talking about. What Kiyosaki says is some investments are only for the wealthy. He means accredited investors. So the first thing is to know whether or not you're accredited. Now, we're recording this in the first half of 2022, and if you're listening at another time, just be aware that right now there is talk about changing these numbers.
Yeah, and so there's really two main things that have happened over the past year. So the first thing that happened is that they actually have already expanded, on the one hand, expanded the definition because the SEC's finally come around to acquiescing to the fact that maybe some other form of test should be done other than financial. So now there's going to be, it's not here yet, but it's going to be some form of a certification program where somebody can go through a course, take an exam, and get certified as an accredited investor, whether they have the financial means or not.
Okay.
That hasn't happened yet. We're still waiting for the SEC to come down and tell us, who can do the certification, but that's coming down the pipeline. But at the same time, there's also some rumblings that the SEC is looking at expanding the net worth requirement from $1 million to, as I've heard, as high as $10 million, which has caused a little bit of an uproar. We expect to have something from the SEC in the April-May timeframe, at least a proposed rule. And I've put some content out there thinking that this actually does make sense because the accreditation numbers are from 1982. Yeah. And in 1982, $1 million meant something. And so today, I think $1 million is about 2.8 million in today's dollars. So just from an inflation standpoint, obviously that's a hot topic these days, it just makes sense for that $1 million number to go up to maybe 3 or something around that realm. But whether it's going to be 3 or 5 or 10, we don't know. But it makes sense because there is going to be an alternate path to accreditation. So, maybe if they increase it to 3 million or 5 million, there's a lot of people who are accredited today that are not going to be accredited tomorrow, but they do have that avenue to go get the certification, take the test, and become accredited that way. So it kind of does make sense.
I think the point here is you need to know, as a passive investor, your status. So here's what's going to happen. The syndicator, the promoter, is going to find out whether or not you're accredited because it's important to them. In fact, we won't get into the technical weeds on this, but there are certain securities exemptions that your clients focus on that require 100% accredited investors in a deal, and that gives them some more latitude and so forth. But in order to do that, they need to prove accreditation, and you can share with us how they do that here in a second. And then there's others that they specifically look for an exemption where they don't need to have accredited investors. And so it's not that one's better than the other, but the sponsor needs to know. Before that happens, you need to know. We meet people all the time that are right on the edge. Like, how do I know what my balance sheet looks like, excluding my personal residence? Let's say I have 5 rental homes and they've all gone up in value. Is it a broker's price opinion? Do I need to have appraisals? How do I know what my net worth is, right? Those kinds of questions. So you need to become prepared. But also, you need to know what the sponsor is going to ask. So how does a sponsor vet a passive investor in this regard?
Great question. And it really depends on the exemption that they're relying on. So there are some exemptions that not only require that you limit your investors to accredited investors, but also require that you take what's called reasonable steps to verify that they are accredited. That usually means looking at their tax forms, looking at their W-2s or 1099s or bank statements or things like that. You can also have the investor's CPA write a letter that says, hey, look, I do this person's tax forms. I'm telling you they're accredited for this reason or that reason. Yep. So there's ways but you just can't take their word for it. We highly recommend, there's a ton of third-party verification companies out there that'll do this very inexpensively. So from my point of view, why get caught up in the compliance of trying to verify them when we can hire a third party to do that?
Well, I think there's another nuance there. So these third-party companies that verify They aren't the sponsor. Sometimes an accredited investor is reluctant to make a lot of their personal financial information available to a sponsor they just met or a deal that's a relatively modest amount of money for them. So they feel better when a third party that does not share the information does the work. At the same time, I've certainly seen pushback from passive investors are like, well, who's this company and what business is it of theirs? That's why we're talking about this now. I would say in most syndications, you would expect a third party to do it, but it may be that the syndicator is going to ask for that letter from an attorney or a CPA, or they're going to want to see it, see proof of it.
Right. And then don't get upset about that, because that is actually, it's not their fault that they're asking for it. It's actually a legal requirement if they're relying on that particular exemption. And I'm glad you brought that up, because yes, under this particular exemption, you're typically advertising and you're talking to investors you've literally never met before. So I can see how investors don't want to just hand over their financial information to a complete stranger. And so having a third party attorney, it's usually an attorney or an attorney group, review it and then provide a letter is very helpful. And then the other way, depending on if you're not doing requiring the verification, the other one, the sponsor can actually reasonably rely on your representation, which is another reason these other exemptions are popular. So you will be presented with a questionnaire. You'll check the box and say, yes, I'm accredited. No, I'm accredited. That way the sponsor can at the very least keep track of, how many accrediteds do I have in the deal and how many non-accrediteds in the deal, because even when they have non-accrediteds, they are limited to the amount of non-accrediteds they can take. So it's very, very important for the sponsor to keep track of that. So it's very common. It's not only common practice, it's legally required for the sponsor to be asking for this information from you. And as you mentioned, it's important for you to know if you're accredited. And by the way, I just got this the other day. There's nothing wrong with if you're on that bubble and you're not 100% sure, maybe you make $220,000, but your spouse makes zero and you're not quite clear on whether you qualify or not. Ask the sponsor. The sponsor typically just forwards that information to their attorney and their attorney will respond. So it's not like you have to do a ton of just ask the sponsor and, hey, here's my situation. What do you think?
We're talking about investing passively in bigger real estate deals. Our guest is attorney Mauricio Rauld. More when we come back, and we'll play real estate trivia next. You're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Live nationwide, you're listening to the Real Estate Guys. Find out more at realestateguysradio.com.
Hey, it's Robert Helms. Thanks so much for listening to the show today. I want to personally invite you to come see an amazing real estate market that combines excellent cash flow, offshore diversification, and what we affectionately call lifestyle investing. Come join me from August 26th to 29th in the beautiful country of Belize. The Real Estate Guys have been bringing investors to Belize for more than 15 years now, and our discovery trip is designed to show you the market like nobody else can. Sure, Belize is breathtakingly beautiful, the people are wonderful, and wait till you taste the food. But the real opportunity is the real estate investment potential. Demand for offshore real estate has skyrocketed since the coronavirus shutdown, and with retirees looking for lifestyle, the work-from-home workforce able to be productive from afar, and tourism coming back strong, now may be the perfect time to consider Belize as a place to diversify risk in your investment portfolio. There's all types of opportunity in Belize when it comes to real estate investing, including both long and short-term rentals, commercial and retail triple net properties, business opportunities, land acquisition, development, agriculture, and more. And as the only country in Latin America with English as its official language, it's easy to understand the law. Property rights are strong, and real estate contracts are in English. And at Ambergris Caye, a unique situation exists where demand for rentals continues to outstrip supply, creating a compelling environment for investors. So come see for yourself. Join me in August in Ambergris Caye, Belize, as we study the market, learn about the sustainable drivers, and tour lots of beautiful real estate. And like all of our field trips, there are no properties for sale during the weekend. Rather, you'll meet lots of local providers that will help educate you about the market so that you can follow up with them after the trip if the market is interesting to you. You've heard about Belize and the Real Estate Guys for all these years. Now come see what all the excitement is about. Plus, we'll have lots of time over meals and activities to talk about all things real estate. To get the details, go to the website at realestateguysradio.com and click on events where you'll find the Belize Discovery Trip. Once you register, you'll get information about our group hotel rates as well as travel details. So join me in Belize, August 26th to 29th. It's a beautiful country with lots of amazing possibilities, and the only thing missing is you. Go to realestateguysradio.com under events, and I look forward to seeing you in beautiful Belize.
Hey everybody, it's Jay Papazan, co-author of The One Thing, and you're listening to The Real Estate Guys.
Welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, join the Real Estate Guys to check out a real estate market or two up close and personal. Next month, we'll be visiting Jacksonville and Ocala, Florida, as well as the beautiful country of Belize. Real Estate Guys field trips are an awesome way to learn a market and get some insider tips. All the details available on the website at realestateguysradio.com. Under the tab that says Events, we're talking with attorney Mauricio Rauld, who's a securities attorney, but today he's talking about approaching investment from the passive side of things. Before we get back to that interview, it's time to play Real Estate Trivia, your chance to win a prize by knowing today's Real Estate Trivia question. Just a minute, I'll ask you a question, and it has something to do with this patriotic time of year we find ourselves in. As soon as you hear the question and think you know the answer, send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. Include your name, the answer, and your physical mailing address, because the first person that gets it right gets an awesome book called Success Habits of Super Achievers. Our guest Mauricio Rauld has a chapter in that book. That can be yours if you know today's real estate trivia question. Last week on the program, it was our show Lessons from Dad with Tom Ziegler, Chris Gronkowski, Jim Griffin, and Peter Schiff. We asked this: where was the first celebration of Father's Day? Well, the first widely promoted Father's Day celebration of modern America was held in Spokane, Washington on June 19th, 1910. There had been a Father's Day observed in Fairmont, West Virginia 2 years earlier, but it had very little publicity. However, it was 1966 before President Johnson established the third Sunday in June as the date of the celebration. Even so, it was not made official until 1972 under President Nixon. Here's our real estate trivia question for this week. As we celebrate the 4th of July, there are 4 presidents on Mount Rushmore: George Washington, Thomas Jefferson, Theodore Roosevelt, and Abraham Lincoln. In what U.S. state are they located? That's a pretty easy one. In what U.S. state is Mount Rushmore located? If you know, and you're quick, you can get a copy of Success Habits of Super Achievers. Just send your best guess to trivia@realestateguysradio.com. Trivia@realestateguysradio.com. You'll need to give us your name, the answer, and your physical mailing address. The first person that gets it right gets Success Habits of Super Achievers. That's today's real estate trivia question. We're talking with attorney Mauricio Rauld. He's a securities attorney that helps investors who want to syndicate deals put together all the legal paperwork, which we're going to talk through here, Mauricio, because I think it can be overwhelming the first time you passively invest. Maybe you bought rental houses and it's a regular contract, you get a loan, and property management, and that's all simple. But these deals can be a lot more complex. And from a paperwork point of view, you get a big old stack of documents. And let's talk about what those documents are, what disclosures need to be made, and how I can make sure that the sponsor is providing everything they need to me as a passive investor.
Yeah, so typically when you're passively investing, you're going to see probably 5 different types of documents, which is why it ends up being, over 100 pages. But the most important one is what we call the private placement memorandum. This is the PPM, which you may have heard of. And the PPM is simply a document where all of the disclosures get put into. So all the risks involved in the deal, all the ways you could lose your money. It's a kind of a scary document, but that's the requirement most of the time for the sponsor to disclose all that information about the deal, the risks of the deal, and then also the information about the sponsor themselves. If they've had any skeletons in their closet, they're required to disclose all of that stuff. I always make the analogy with that medical consent form, right? If you've gone to the doctor and you had some surgical procedure, they give you that. It used to be a yellow sheet, and they would tell you all the ways that your surgery could go wrong. I tend to have a lot of oral surgery with my teeth, and it's, you could have an infection with the procedure, you could have some bleeding, you could die from the procedure. I mean, even though it's unlikely. And so you review that, you sign it, and the doctor countersigns, and then you're off to the procedure. Same thing. It's just a document that just puts you on notice. And the idea is for you to go into these investments with eyes wide open, all the risk, and then you can make an intelligent decision whether you want to invest or not. So that's the private placement memorandum.
And many times you don't see that at the beginning, right? The sponsor is going to give you their business plan or executive summary or 2-pager that says, hey, here's the deal. And once you indicate, hey, this sounds good, I think I'm interested, you cannot proceed with funding that until you go through these documents. And let's talk about that side, because an attorney has prepared these documents. but it's not your attorney. So how important is it that, one, I read all 100 plus pages, and two, do I need counsel? Do I need an attorney to review on my side? What about my tax professional? Talk about that side of it.
Yeah, that's a great point. I mean, a lot of passive investors are definitely hesitant to spend a little bit of money on the front end to have a professional, an attorney review these. But it just goes back to that old adage that an ounce of prevention is just the great way to go, because if things go south in the future and you realize 5 years from now that the operating agreement wasn't properly drafted, or this issue, or that you thought you were getting this, but it turned out you were getting something else, this is the time to do it. And it's for the amount of money you're investing. I mean, you can have a securities attorney review the documents for you for, $400, $500, $600. It's not like we're talking thousands of dollars. And if you're putting in $100,000 or even $50,000, again, that's good insurance for you to do that. So, and then the CPA, same thing. A lot of times, you think you're getting a certain tax treatment because the sponsors told you and you're reading it. But then again, the operating agreement, which is the second document that you usually see, that's where it outlines from a legal perspective how the tax benefits are going to flow or roll up. And so it is important for your own CPA also to review at least the tax section. There's a tax portion of the operating agreement. Have your CPA review that and say, hey, look, my understanding is I'm going to get this, and then your CPA can say, well, I'm reading the document, and that's exactly what it says, or maybe it doesn't say that, and that's something you can bring up to the sponsor.
Yeah, excellent point. You definitely want to listen to the sponsor's position, but you can't rely on the sponsor of a real estate deal or any other syndication to give you legal or tax advice. So ounce of prevention, absolutely. Now, in addition to accreditation, Mauricio, I've heard people talk about a couple of things like sophistication. I only take sophisticated investors. And then there's this whole thing about having a substantive relationship. Talk about those two parts, because this is really interesting, especially in the light of the definition of accreditation possibly changing.
Yes. And so sophistication actually plays into both of those questions. So let's go through that first. A sophisticated investor is simply an investor that has sufficient knowledge and expertise in business and financial matters that they can properly evaluate the risks and the benefits of the investment.
Yeah.
And so you're always looking for sophisticated investors, whether they're accredited or not. Now, the law assumes that if you're accredited, that you're also sophisticated. So
which we know in the real world is probably not.
We know that's in the real.
Yeah.
But when they are non-accredited, then it's the sponsor's responsibility is to ensure that they are a sophisticated investor. And the way they do that is by obviously communicating with them. And one of the requirements that kind of fosters into the next question, one of the requirements that the sponsor must have or relationship they must have is a pre-existing substantive relationship with the past investor. And having a substantive relationship basically means going back and forth with the sponsor to determine, are they sophisticated? Is this investment suitable for them? So they're just asking a lot of questions, sending them questionnaires, having them, incentivizing them to ask questions, and just fostering that communication so that you really understand after a week, a month, a year, that this investor, yes, they're sophisticated enough, they understand the risks and the merits of the deal, and we can accept them now because it's a suitable investment for them.
And this really is a two-way street. The sponsor needs to get to know the investor and their position and experience and their objectives and all that. But also the passive investor needs to understand who the sponsor is and why they're doing what they do. And for instance, some sponsors have a long runway. They're able to bring lots of deals to you, and other sponsors do a deal every 3 years. So it doesn't make it bad. You just want to know, if I'm thinking, over the next few years, I'm making some good money, I want to continue to passively invest, then you might choose a different sponsor. And it doesn't mean you can't do deals with multiple sponsors. Many people do. In fact, this is one of the ways where you can do the compared to what. If I've been through 2 deals with completely different sponsors, with different attorneys, the paperwork can vary fairly substantially.
Right. And this is the time for you to be asking those questions to the sponsor, right? So, I mean, we've got a list of questions that we would recommend you asking, but that's the time, is when you're establishing that substantive, or when the sponsor is trying to establish that substantive relationship. Like you said, it's a two-way street. The passive investor is also the one that is asking those questions to the sponsors to figure out, again, do the values align? Are they qualified? Do they have a team? All the things we talked about earlier.
Well, what about this situation, Mauricio? You've got your money and it's working with a sponsor. You're the passive investor. And now every year you need to take all the information on income, expenses, depreciation, and have your tax professional prepare that. What's that process like, and what do people need to be thinking about?
Yeah, and I'll give you my disclaimer that I'm not a tax professional, but check with your own tax professional. But generally speaking, a sponsor will issue all of the passive investors what we call a K1.
Yep.
And a K1 is a tax document that's prepared by the CPA of the sponsor. They'll prepare the tax forms, and then they'll prepare 10, 20, 50, 100 K1s, one for each investor, and they'll send that to you. And that K1 will indicate the profits, the loss, the sort of the net operating income, and what percentage you own of the deal, and therefore what percentage of that profit or loss is being allocated to you. And then you take that number, that's either hopefully a profit, but sometimes a loss, and especially with bonus depreciation, sometimes you may want a loss.
Yeah.
But that number that gets translated into your personal tax return, and that K1 is sort of that proof of that information.
Now, Mauricio, while most of our listeners do reside and work and invest in the U.S., we have listeners in more than 190 countries, and pretty much every country has some version of securities law. And this is important because if you are deciding to invest in a foreign market, just understand the rules may be different. I know you have clients who are investing outside of the U.S., but they use U.S. entities and U.S. tax forms and all that kind of stuff. So it feels like a U.S. investment, even though the property might be in another jurisdiction. But sometimes when you invest offshore, you're not going to see K1s and U.S. tax forms and those kinds of things. So any advice there?
Yeah, I mean, if you're a passive investor investing in a different country with, a non-US, then you definitely want to make sure you have some kind of representative in that country. Because as you mentioned, Robert, every country has different securities laws. Some of the countries, like Canada, for example, have very robust securities laws, but then there are other countries that basically don't even know what securities laws are.
Yeah.
But that's why it's important for you to reach out to somebody in that country. But yes, they're not going to issue you, for example, on the K1 issue, they don't know what US tax law is or anything, and nor should they. And so they're not going to give you a K1. They're going to give you another sort of what we call a profit and loss statement. But you're always getting something from that international sponsor that you can then pass that along to your CPA, which again, it's very important for you to be working with CPAs when you're investing passively, whether it's in the United States or overseas.
And if you do it right, this is all the work you're going to do up front, and then it really does become passive. You're getting the reports once a year, you're taking the information to your accountant. I mean, it doesn't take a ton of work. But every time you consider a new sponsor or a new market, well, you want to go through this process. It's that little bit of work up front to save you the time in the long run. Any other ideas that are necessary that you want to share with potentially passive investors?
I think the last thing, which kind of goes into that idea of reviewing the documents, ideally with some attorneys, just making sure the documents all match, right? So there's something that they've told you orally in a conversation, then there's something that's in the pretty pitch deck and they're representing things there. And then there's the PPM, the private place memorandum, but there's also the operating agreement. And if a lot of times I've seen the PPM doesn't match the operating agreement. They may tell you, hey, you're getting a 7 or 8% preferred return, but that's nowhere to be found in the operating agreement. And ultimately, the operating agreement is what actually governs. And so it's really important for you to be just paying attention, whether it's you or somebody else reviewing it on your behalf, to make sure those things match, because ultimately it's the operating agreement that's going to count if there's ever some kind of a dispute.
Well, there's a lot more we could cover, but this has been a great introduction to passive investing. If you're serious about investing passively, I would suggest you come and check out our 2-day event on syndication, The Secrets of Successful Syndication. It's actually designed for folks who want to become deal sponsors and do bigger deals, but over the years, about 20% of the audience are there for this reason, and that's why I wanted to do this show. I think it's an awesome opportunity to invest in real estate passively and not having to do all the work, having been the guy and part of the team that does a lot of the work for a lot of years. My favorite thing today to do is to give somebody else the ball, right? But you speak at that event, and what you're going to be covering at the syndication event is from the deal sponsor side. So, Mauricio, the reason I would suggest a passive investor hears that is because then they know exactly what a deal sponsor is supposed to do.
Yeah, 100%. I mean, that's the best way to learn anything, is to learn the other side of whether it's an argument or something else, learn the other side. So knowing what the requirements are from a sponsor standpoint will put you in a much better position when you're doing those due diligence calls and asking the proper questions.
Well, this has been awesome. A lot of information, and you may be working out, you may be driving, you may be doing something fun. So if you'd like a nice synopsis of what we've talked about, Mauricio's prepared a cool report on the top 10 questions to ask a deal sponsor. What's in the report?
There's actually 10 questions you should ask a deal sponsor.
Oh, okay. Excellent.
Just a little help for you to, when you're having that, that conversation with the sponsor and you're trying to figure out whether this is a good match, you can have this little checklist of these questions that you kind of as a guide for you to ask the questions, and hopefully that'll help you guys out.
If you're interested in that, send an email to dealsponsor@realestateguysradio.com, dealsponsor@realestateguysradio.com, and we'll get you that report. Mauricio, it's always good to catch up. Thanks for sharing with us today.
Thanks for having me.
There's attorney Mauricio Rauld. You can see him at the Secrets of Successful Syndication coming up in Dallas, Texas in September. Get all the details about the event at realestateguysradio.com under events. When we come back, you're tuned to the Real Estate Guys radio program. I'm your host, Robert Helms.
Real estate investment advice right in your mailbox. Sign up for the free Real Estate Guys newsletter at realestateguysradio.com.
The Real Estate Guys are throwing a party and you're invited. Join us live at the New Orleans Investment Conference, October 12th through 15th. Now in its 48th year, it's the nation's longest running investment conference and features some of the biggest names in economics and investing, including Jim Rickards, Danielle DiMartino Booth, Rick Rule, Doug Casey, James Grant, and George Gammon. And of course, the Real Estate Guys are speaking again this year. Plus, we're hosting an awesome party one of the evenings with some very special guests. So make plans today to join the Real Estate Guys at the New Orleans Investment Conference. With all that's going on in the world, no serious investor can afford to miss it. Send an email to neworleans@realestateguysradio.com and we'll get you all the details. That's neworleans@realestateguysradio.com.
Hey, ever wished you could go back in time and do some tax planning? Now you can, just like Marty McFly. Lucky for you, a brand new federal law just made this possible with an EQRP to get tax deductions and reduce your taxable income from last year, so you can use that tax savings to invest in real estate, Bitcoin, gold, even your own business. Whether you're a full-time investor, doctor, government employee, even if you have 5 or 50 employees, the EQRP works and is your secret weapon, and now it's retroactive. Hey, I'm Damian Lupo, and we have your solution. By the way, if you got bad advice and used an IRA for an apartment syndication, you are sitting on a U-bit time bomb. But don't worry, there's a solution, the EQRP. The EQRP company is ready to help you get control of your money, kill U-bit, and help you pay way less taxes. Want to learn more about this strategy? Send an email to eqrp@realestateguysradio.com for my special EQRP report. Paying tax or letting Wall Street suck you dry is dumb. Your first step is freeing your retirement money by sending an email to eqrp@realestateguysradio.com today.
Hi, this is Donald Trump, and you're listening to the Real Estate Guys.
And welcome back to the Real Estate Guys radio program. Thanks for tuning into the show. Hey, if you ever want to do bigger deals using other people's money or passively invest like we're talking about today, the next time you can learn all about that is at our Secrets of Successful Syndication workshop. It happens in the middle of September in beautiful Dallas, Texas. To get all the details, just send an email to syndication@realestateguysradio.com. Well, always good to hear from Mauricio and some really salient points for passive investors today.
It's been fun to watch his career blossom as he's moved into this niche and really become the go-to guy nationwide. He's probably one of the best known private placement syndication attorneys out there, and certainly a big part of our program, been a member of our faculty and a contributor to our show for a long, long time. I think really, if you listen to what the conversation was about, it boils down to there's two essential parties. There's the active people who are hands-on, making the deal happen, whether you call them promoters, sponsors, syndicators, whatever it is. And then you have the passives, the people that are bringing the capital, that don't want to get their hands dirty, that want to see their capital grow. And so it's very like investing with Wall Street, except that you're investing in real assets with someone that you actually have a relationship with. And I think that's really the key point. We're talking about how do you get in the game. First thing is, Mauricio talked about the importance of making sure that you pick a deal that lines up with the investment objectives for your capital. In other words, if you're investing for income, then you got to pick a deal that's going to generate income. If you're investing for capital gain, you pick that, tax breaks, privacy, whatever it is. So you really have to kind of know what you need your portfolio to do, or this portion of your portfolio to do. And a good syndicator will ask you some of those questions, and they'll be able to explain to you what their deal does. The big thing there was it's a lot more important to vet the team, the jockey, if you will, than it is to understand the nuances of the deal. I mean, it's important that you do, but it's really important that you know that you're dealing with somebody who actually can get the deal done. And then you evaluate the business plan, you look at the offering memorandums, you understand all the risks, you consider with your tax advisor and your asset protection or estate planner where it's going to fit into your portfolio and all of that. And then at that point, you make the investment, not a big part of your portfolio, a smaller one, and see how the guy does. If it works out well, then you can do more. And I love the idea of leveraging your due diligence, expense, and investment and finding someone who has good deal flow. I think that's an important consideration. And then I think the last thing that really begs the question is, where do you find these people? Right? I mean, if you're going to vet jockeys, you got to get in a room full of jockeys. We obviously have the secrets of successful syndication. That's a great room to be in. You can join a local club and get to know investors, and through there, many people will be syndicating. The key is get into a pre-existing relationship, and we can maybe talk a little bit more about why that's important and how to do that. But it's not difficult to be a passive investor, but there are a couple of things you have to be good at.
Absolutely. And there's no hurry to jump into a deal. I think getting to know sponsors is huge. And not just, hi, how are you? What do you do? Give me your business card. I mean, really finding out. A lot of them will make information available about their past deals. Think of them as case studies, right? Hey, here's a deal we did in this town, and here's the type of property we did here. And it lets you just see, have they thought it out? How did their results compare to their projections a year or 2 years ago? And obviously, we give some grace for things like the pandemic. But overall, you're looking for somebody with a track record. If you don't have any exposure to those kinds of folks, you might consider joining our investor registry. It's a way that we do our best to help people who want to be passive investors find deals. And if you'd like to learn more about it, just send an email to investorregistry@realestateguysradio.com, investorregistry@realestateguysradio.com. Think of it as a bridal registry for investments. And so that's an option. I think the other thing is to ask people in your circle who have successfully been passive investors, hey, how'd it go? Where did you find the sponsor? Are they looking for other investors?
Well, I think one of the most important things Mauricio mentioned, there's the potential changes in what is considered an accredited investor. If you're accredited by today's standards, then people can advertise. They're easy to find people who have these kind of deals because they're out there looking for you. But if the rules change, and you're not that $10 million net worth person, then these deals are going to be hard to find. And you're going to wish that you had a pre-existing substantive relationship with someone who has these kind of deals. So if I'm a syndicator out there right now, I'm going to do whatever I need to do to get into as many relationships as I can with people that are in that $1 million to $10 million range, because they may be off limits to you someday if they're no longer considered accredited. If I'm on the other side of the equation and I'm somebody in that $1 million or even below, but between that $1 million and $10 million limit, I want to get into a relationship with as many syndicators as possible so that I have that pre-existing relationship in place, that I'm eligible to look at their deals and invest. Because this is really, in my opinion, and maybe this is just me with my tinfoil hat on, this is Wall Street waking up and going, hey guys, you know what? We're losing, millions, billions of dollars to Main Street syndicators who don't want to play in our casinos anymore. We got to change the rules and make it harder. There's a window of opportunity to get into these relationships. I would do whatever you need to do in the next year or less to get into those relationships so that you have as many options as possible available to you to invest in Main Street.
Mauricio's put together a great report called The Top 10 Questions to Ask a Deal Sponsor. If you'd like to get a copy of that, just send an email to dealsponsor@realestateguysradio.com, dealsponsor@realestateguysradio.com. Big thanks to Mauricio Rauld for sharing his ideas with us. He'll be at the Secrets of Successful Syndication in September, and so will attorney George Ross. George is one of the most awesome guys, been in the business a long, long, long time. He's in his 90s, but his mind is probably in its 20s. So come on out to the Secrets of Successful Syndication. Get all the details by sending an email to syndication@realestateguysradio.com. Coming up this month, you'll hear two shows we recorded on the 20th Annual Investors Summit on Sand. Lots of amazing guests. But next week, we'll say hello to David Green from Bigger Pockets. Until then, go out and make some equity happen.
This episode of the Real Estate Guys radio show is brought to you by Paradigm Life. Powerful cash management strategies using life insurance. Learn more at beyourbank.com. Mid-South Home Buyers, low-cost, turnkey cash flow properties in Memphis, Tennessee. Corporate Direct, asset protection strategies for real estate investors from attorney and rich dad advisor Garrett Sutton. Find these and other great companies under the Resources tab at realestateguysradio.com. To learn how you can expose your product or service to the Real Estate Guys audience, call 888-489-7723 extension 4. That's 888-489-7723 extension 4. Or use the feedback page at realestateguysradio.com. Thanks for listening, and we'll see you next week right here on the Real Estate Guys Radio Show.